Hello everyone, this is Victor here. Welcome back to the Intelligent Investor channel. Several subscribers asked me to take a look at Fortinet stock to see if the stock is undervalued now, after the stock tanked as much as 25% right after its most recent earnings release. As of now, Fortinet is one of the largest cybersecurity companies in the world, just right behind Palo Alto Networks. At the time of making this video, Fortinet's market cap is at 45 billion. Fortinet's stock did drop as much as 25% right after the company released its Q2 earnings. Fortinet's management gave very soft revenue and billings guidance that were much lower than Wall Street's expectations. The biggest reason is this: Fortinet's management reported that a large number of deals were delayed to future quarters because of many macroeconomic uncertainties. So both Fortinet's revenue growth and billings growth have slowed down a lot in the most recent quarter. Also, Fortinet lowered its full-year guidance. This suggests that Fortinet's growth will likely slow down a lot, at least over the next several quarters. Of course, past performance does not guarantee future results, but I still want to show you Fortinet's past performance here. Even after the recent 25% drop, Fortinet is still outperforming the S&P 500 slightly this year. In the past 5 years, Fortinet did outperform the S&P 500 by a large margin. So in this video, I will talk about why I think Fortinet is likely undervalued at the time of making this video. I will show you how to calculate Fortinet's intrinsic value in this video. I will talk about these topics: Fortinet's business review, Fortinet's biggest risk, Fortinet's economic moats and long-term growth prospects, Fortinet stock valuation, and will I buy Fortinet stock? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock reviews and investing videos a week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make. So if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members grow their stock portfolios to over 7 figures over time. Once you become a Patreon member, you can follow all the stocks I'm investing in for the long term and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about Fortinet's biggest risk and long-term growth prospects, I want to give you a business overview of Fortinet and show you its most recent financials. Fortinet is one of the largest cybersecurity companies in the world. Fortinet provides end-to-end cybersecurity infrastructure products and services, such as firewalls, antivirus tools, intrusion prevention, and endpoint security. The complete cybersecurity platform can address critical security challenges and can protect data across digital infrastructure systems, whether in networked, application, multi-cloud, or edge environments. Fortinet provides security products and services such as FortiGate Next-Gen Firewall, Fortinet Security Fabric, and FortiOS platform. Fortinet sells its security products and services to distributors, networking security providers, and other managed security service providers. Then Fortinet's distributing partners sell Fortinet's security products and services to the end users such as small and medium-sized businesses, large enterprises, government agencies, and any companies that need network security services to protect against cyber attacks. At the time of making this video, Fortinet has over 600,000 customers in different industries, including retail, manufacturing, financial services, government, healthcare, information technology, and telecoms. Based on what I know, Fortinet is most well known for network security and is a market leader in the firewall category. According to IDC's latest quarterly security report, Fortinet has been the #1 unit in the firewall category for 10 consecutive years with over 50% market share. Fortinet is now the market share leader in both units and revenue. I want to show you Fortinet's most recent financials here. At the time of making this video, Fortinet's service revenue is already more than product revenue. Around 37% of the total revenue is from product sales, and the remaining 63% is from service sales. Around 35% of total revenue is subscription-based. Fortinet's operating margin is around 22%. This suggests that Fortinet has a very profitable business model. In comparison, if you look at other similar cybersecurity companies, many of them are still losing money and are not as profitable as Fortinet. If you look at Fortinet's revenue growth here, you can see that Fortinet's service revenue growth has been much more consistent, between 20% and 30% each quarter. Typically, service revenue growth is more consistent than product revenue growth because a large percentage of service revenue is subscription-based. In comparison, Fortinet's product revenue growth has slowed down a lot in the most recent quarter here. I said this earlier, a large number of deals are delayed to future quarters due to many macro uncertainties. I will talk more about this later on in this video. Overall, Fortinet has been growing its revenue consistently for many quarters even though its revenue and billings growth are expected to slow down going forward. Fortinet's operating income has also been growing consistently for many quarters. Fortinet has been growing its earnings per share consistently for many quarters. Since Fortinet's IPO more than 13 years ago, Fortinet has been improving its operating margin gradually for many years. This suggests that Fortinet's management is focused on improving its operating margin over time, not just focused on revenue growth at the expense of margins. Here, you can see that Fortinet has been growing its free cash flow gradually for many quarters already. In my opinion, I think Fortinet has a very healthy balance sheet. Here, you can see that Fortinet has minimum long-term debt compared to the amount of cash it has. For example, at the time of making this video, Fortinet has around 3.31 billion of cash equivalents and marketable securities. In comparison, Fortinet only has around 991 million of long-term debt. This means Fortinet can pay off all its long-term debt and still have around 2 billion of cash left. When it comes to investing, we also need to look at the biggest risk. In the short term, I believe Fortinet's biggest risk is lower revenue growth and billings growth going forward. If you look at the financials here, you can see that Fortinet's billings growth was much higher in the last 2 years. This is because Fortinet's business benefited a lot from the pandemic and supply chain related issues. Many people started working from home and working outside of the office. This increased the demand for Fortinet's cybersecurity products and services. Based on my understanding, many companies likely ordered more security products from Fortinet than needed because many companies thought that the supply chain issues would continue longer. Now, many pandemic and supply chain related issues have eased. There are many macro uncertainties such as high inflation around the world, high interest rates, restrictive monetary policies around the world, the war in Ukraine, and a potential recession in the US and Europe. This is why many Fortinet customers decided to delay closing their deals with Fortinet until future quarters. Fortinet's billings growth has slowed down a lot in the most recent quarter here. Billings is a leading revenue indicator. Billings tells us how much revenue Fortinet will earn in the upcoming quarters. So lower billings growth means that Fortinet will likely have lower revenue growth in the upcoming quarters. Here's the important part I want to show you. It shows that Fortinet's billings growth and revenue growth will slow down at least for the next several quarters. Fortinet's management gave this guidance for the upcoming third quarter and the full fiscal year. In the upcoming third quarter, Fortinet expects that its billings will grow by around 13% year over year and expects that its revenue will grow by around 17% year over year. For the full fiscal year, Fortinet expects that its billings will grow by around 17% year over year and expects that its revenue will grow by around 22% year over year. This updated guidance is below Wall Street's expectations. This is why Fortinet stock tanked as much as 25% right after its earnings release. We have to be realistic going forward. We should not expect Fortinet to have the same high revenue growth rates as in 2021 and 2022. Here's another risk we should consider. At the time of making this video, Fortinet's PE is at around 43.5 and its forward PE is at around 35.6, even after Fortinet stock tanked 25% recently. If Fortinet's forward PE is at 30, I think it's more reasonably priced because Fortinet's revenue growth is expected to be lower going forward. According to this forecast, Fortinet's revenue is expected to grow in the high teens over the next 4 years. Here is another risk. Fortinet does have many competitors in the cybersecurity industry. As far as I know, there are more than 3,500 cybersecurity firms in the US and over 30,000 security products and service providers in the world. Fortinet's biggest competitors are CrowdStrike, Palo Alto Networks, VMware, Zscaler, Checkpoint, and Cisco. Personally, I don't work in the cybersecurity industry, so I cannot predict whether Fortinet will still be one of the market leaders in the cybersecurity industry in the long run. I want to talk about Fortinet's economic moat and long-term growth prospects here. Based on my understanding, Fortinet is most well-known for network security. According to IDC, Fortinet is a market leader in the firewall category. Even though there are thousands of cybersecurity firms in the world, I think the largest cybersecurity companies tend to have the biggest competitive advantage and economic moats. Because of their large customer base, their large network effects, and the high switching costs once their customers start using their security products and services. Typically, I think most organizations, large enterprises, and governments want to work with the largest and most well-established cybersecurity vendors instead of the less known security vendors. And Fortinet is one of the largest cybersecurity vendors in the world. For example, Fortinet already has over 680,000 customers worldwide, ranging from small and medium-sized businesses to governments and large enterprises in different industries. Fortinet has been consistently attracting more deals every quarter, ranging from $50,000 per deal to over $1 million per deal. I think Fortinet's large customer base and the increasing number of deals every quarter are likely creating a large network effect for Fortinet. As far as I know, many smaller cybersecurity vendors will likely consolidate or get acquired by the larger cybersecurity firms because many smaller cybersecurity vendors cannot compete over the long run. This from Morningstar. I think the analysts here did a great job explaining Fortinet's competitive advantage and why Fortinet has a larger economic moat, even though there are thousands of cybersecurity vendors in the world. We assign Fortinet a wide moat rating, owing primarily to strong customer switching costs, to second due to a network effect associated with its offerings. We believe that Fortinet's platform approach to cybersecurity by combining key aspects of business security needs under one umbrella has also enabled the firm to grow its wallet share among existing clients while adding new ones. As a result, we forecast the firm to generate excess returns on invested capital over the next 2 decades. As we look at the broader cybersecurity segment, we believe the complexity and intensity of threats are ever increasing. Enterprises continue to adopt software as a service solutions, undergo digital transformations, and migrate to the cloud, all while employees work remotely. In turn, we see the number of attack vectors or entry points for nefarious players growing rapidly. Similarly, the intensity of digital threats is also on the rise, with high cost of a data breach, including punitive fines for any customer data theft. Across our coverage, we see high switching costs for enterprise-focused cybersecurity vendors, such as Fortinet, that often have an expensive footprint across an enterprise. To uproot such a vendor requires not only a competitive offering from another vendor, but often retraining staff to use the new platform, a period of increased vulnerability. Additionally, we believe security-related IT decisions are driven by security analysts and engineers that focus on performance rather than price, so enterprises are unlikely to rip out cybersecurity solutions as a source of potential cost savings. Further, by remaining neutral to form factor and deployment, Fortinet is able to land customers with varying network security needs. We have seen the company move up market by targeting large customers that tend to be stickier and have a higher lifetime value. Along with high switching costs, we believe a network effect reinforces Fortinet's economic moat. Cybersecurity in its essence is a data problem, and attacks are now too overwhelming to be handled manually. In turn, vendors have developed AI solutions to automate processes and pick up threats, especially zero-day attacks, that have never been seen before. However, artificial intelligence and machine learning solutions are only as good as the data that's fed to them. This need for good quality data is where we see entrenched platform vendors such as Fortinet having an edge as they have data streaming into security solutions from across the enterprise. By collecting and analyzing this rich data coming into its platforms, a platform vendor such as Fortinet can uncover threats and new threat signatures that can then be used to update its entire client-based security situation. As more data comes in, Fortinet's platforms become better at detecting and mitigating cyber threats. As a result, more customers join Fortinet's platform due to superior products, which in turn leads to more data, and the flywheel spins faster. We see this network effect as reinforcing switching costs as well, with customers hesitant to leave Fortinet as it may entail losing the latest threat updates essential to maintaining secure IT infrastructure. In terms of long-term growth prospects, I think several security trends will drive Fortinet's growth going forward, even though Fortinet's revenue and billings growth will likely slow down to mid-teens or high teens going forward. First, more enterprises, especially publicly traded companies and more governments, are investing in more cybersecurity services in order to fend off cyber attacks from hackers and cyber criminals. Based on what I know, investing in cybersecurity products and services is mission critical for many large organizations because of the amount of sensitive data they have. If a company is hacked, the company can lose very sensitive data, lose its reputation, lose customers' trust, lose sales, have large financial losses, and get fined by regulators. Hackers tend to target large organizations that have very valuable and sensitive data, so it's mission critical for many large organizations and governments to invest a percentage of their IT budget in cybersecurity services every year. This is why I think the cybersecurity market will continue to grow for many years. According to Statista, the number of cyber attacks and the cost of cybercrime are expected to grow going forward. Also, the cybersecurity market's worldwide revenue is expected to reach $256.6 billion by 2028. Overall, I think these long-term cybersecurity trends will benefit the larger cybersecurity companies, such as Fortinet, going forward. I showed you this revenue guidance earlier. In the short term, I believe Fortinet's biggest risk is much lower revenue growth and billings growth over the next several quarters. Recently, many Fortinet customers decided to delay their deals with Fortinet to future quarters because of many macro uncertainties. In the past 2 years, you can see Fortinet's billings growth was much higher, both 30% in most quarters. Going forward, I think Fortinet's billings growth will slow down to mid-teens or high teens over the next several quarters. This from the most recent earnings call. I think it indicates Fortinet's expected growth going forward. Given our confidence in our solutions, our offers, and taking into account that growth comparisons will ease as we move throughout 2024, at this early stage, we will expect billings growth to approach high teens by the fourth quarter of 2024. We believe things will be recovered in the later part of next year, and because the last 2 years, we see quite a strong product revenue growth, second quarter over 50%, which is not quite normal. But once we get more normal, so that will be pretty much return to the average in the last 20 to 30 years, which is about 10% to 20%. Over the past 2 years, Fortinet's billings growth and revenue growth were much higher than normal because of the pandemic and supply chain issues that drove up the demand for Fortinet's cybersecurity products and services. This is my own forecast. Going forward, I think Fortinet will return to more normal pre-pandemic growth rates between 15% and 20% each year. I think Fortinet's billings growth will likely reach a trough by Q4 this year or sometime in 2024, similar to the billings trough in 2013. Then once the overall economy gets better and when there are less macro uncertainties, Fortinet's billings and revenue growth should recover afterward. In terms of consensus revenue forecast, Wall Street analysts expect that Fortinet's revenue growth will be lower going forward after 2023. Fortinet's revenue is expected to grow by the mid-teens to high teens each year after 2023. I think these revenue growth estimates are reasonable because they are very similar to Fortinet's pre-pandemic growth rates. In terms of EPS forecast, Fortinet's EPS growth is expected to be higher than its revenue growth over the next 5 years. This is because Fortinet will likely improve its operating margin going forward. I want to show you how to calculate Fortinet stock's intrinsic value here, so you will know when Fortinet stock becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Fortinet's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 11.5% here. You can use a higher discount rate here if you want to be more conservative. I expect Fortinet's free cash flow margin should be around 35% over the next 5 years. This is similar to Fortinet's free cash flow margin over the past 5 years. Based on the market trends and the revenue guidance I talked about earlier, I believe Fortinet's total revenue will grow by about 12.5% to 17.5% each year over the next 5 years. My base case scenario is that Fortinet's total revenue will grow by about 15% each year over the next 5 years. I think this is a reasonable growth rate. Let's go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting that Fortinet's revenue will grow at a compound annual growth rate CAGR of 12.5% over the next 5 years. If we forecast Fortinet's free cash flow over the next 5 years and discount the free cash flow to the present day, Fortinet's intrinsic value should be around $51 billion for the entire company, or $64 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting that Fortinet's revenue will grow at a CAGR of 15% over the next 5 years. Then Fortinet's intrinsic value should be around $57 billion for the entire company, or $71 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that Fortinet's revenue will grow at a CAGR of 17.5% over the next 5 years. Then Fortinet's intrinsic value should be around $62 billion for the entire company, or $78 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Fortinet's intrinsic value should be around $71 per share. I also used the forward price to sales valuation model here to estimate Fortinet's intrinsic value, which should be around $47 billion for the entire company or around $59 per share. If we take the average of both valuation models here, I believe Fortinet's intrinsic value should be around $65 per share. This means I believe Fortinet is undervalued at the time of making this video. Just to compare, Morningstar estimated Fortinet's fair value to be $68 per share, so this is very close to my intrinsic value estimate of $65 per share. So will I buy Fortinet stock? Yes, I will likely buy Fortinet stock going forward if it's still greatly undervalued. If I buy Fortinet stock, I will likely just buy a very small position. This is because Fortinet has many competitors in the cybersecurity industry, even though it's already one of the market leaders in the industry. I said this earlier, I don't work in the cybersecurity industry, so it's very hard for me to predict whether Fortinet will still be one of the market leaders in the long run. So if I decide to invest in Fortinet stock when it's undervalued, I will likely buy a very small position to reduce risk. At the time of making this video, I don't have Fortinet in this portfolio here. I also have other portfolios with almost the same stocks and the same investing strategy. Also, at the time of making this video, the market is in a correction. There are many macro uncertainties, such as the war in Ukraine, China's second largest real estate developer defaulting its debts, high inflation and high interest rates in many countries around the world, high short-term US Treasury yields that are above 5%, and high 10-year US Treasury yield that's above 4%. Very high US Treasury yields make US equities more risky and less attractive to buy. US Treasuries are almost risk-free if you hold them until they mature. And if US Treasuries pay very high yields above 5%, then it makes sense for many investors to buy almost the risk-free US Treasuries as long as they are willing to hold them until maturity. Of course, I cannot predict the market. I don't think anyone can predict the market accurately, not even Michael Burry. I plan to sell more overvalued stocks going forward to take the short-term gains and reinvest the capital in more undervalued stocks that are outstanding businesses. For example, before making this video, I sold some of my Tesla shares and made a 82% gain. Then I reinvested the capital in other undervalued stocks that are outstanding businesses. Going forward, if the market corrects more, I plan to invest more every month whenever I have extra savings. I'm planning to keep buying the dip and keep buying shares of the best businesses that are undervalued. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.